the Gould Mine podcast.
And part of my thesis has also been, I don't look for real distressed properties to fix them up. And, I really look for maybe A-, B+ neighborhoods.
Mm-hmm.
So I prefer kind of newer properties to the extent I can, and better neighborhoods, higher median incomes. So I kind of stayed away from like distressed areas, in other words, and kind of focused on, B, A- type properties. And that's worked well for me. I mean, there's a lot of different strategies. I'm not knocking anybody else who's doing the other things. It's just, this has worked for me. So I've kind of continued to deploy this strategy, right?
In hearing your kind of investment thesis, what that signals to me is that, yes, there was some emphasis on cash flow, but generally those types of properties are a little bit more like appreciation, have a little bit more appreciation potential, right, than cash flow potential. So when you go into like those blue collar, like really like, C-level areas, you're getting like really healthy cash flows, right? But the appreciation potentials just aren't quite there. So I'm sure that, especially in the single family sector, which is the best sector to invest in my opinion, right, for appreciation and for growth, it sounds like you kind of took advantage of that. So you found properties that were at least like cash flowing something, right? Areas where you could at least get some cash flow, unlike the Bay Area now, where like basically you have to put 50% down just to cash flow like a couple $100 a month. So yeah, put $500,000 down to cash flow $200 a month, right? But you found areas where you could put 25% down, get some appreciation, get some cash flow, but then really see a lot of appreciation over the next 5 to 10 years. Because as you said, you're looking for high growth areas. That's
right. I mean, some people have different objectives. Some people, I had up until very recently, I had a day job, I had a salary, right? And so I wasn't relying on real estate income, right? So part of my longer term view was, appreciation's great because I don't need the current income. The other thing I've noted, there's people go after kind of C- areas. On paper, sometimes the cash flow looks appealing, but in reality, sometimes those returns are elusive because there's generally more delinquency, evictions, damage to property, things of that nature, repairs, right? Some of these are very old properties that have a lot of deferred maintenance. So sometimes the reality of cash flow on the older properties isn't what is perceived to be, right? And so a lot of the stuff I was buying was new build, new build townhomes and so forth. So what I really like about that is that there's no deferred maintenance and you have runway 5 to 10 years where you have minimal maintenance, right? It's, roofs aren't going to go bad, HVACs aren't going to go bad for a while. And so it's just a lower risk. Even if cash flow is a bit tighter initially, they're more predictable, right? More predictable cash flows for sure.
Yeah, that's really is interesting. And actually, it's so funny because when people ask me here in the Bay Area, because in a previous life, I was a realtor, right? And so when people ask me like, hey, what's the best type of property to invest in here in the Bay Area for like the last 10 years, one of my top responses has always been, if you can get in phase 1 or phase 2 of any new build here, you're going to be fine. And you're going to see a ton of appreciation in like a very short amount of time. So that's interesting that you have found similar situations in high appreciation or high growth markets. I mean, that's really smart, man. I think that there's a lot of people that could take that same investment thesis and do like a lot of good for themselves. I think the one thing that a lot of people kind of like hesitate or balk on the idea of investing out of state or in an area that's not necessarily theirs is like, well, they don't have as much control or as much oversight over the property. So how did you mitigate or how did you overcome those challenges when managing a 20 unit portfolio right before you scaled that was almost completely out of your immediate, reach?
Yeah, those are legitimate concerns. The property management is a big factor, right? So fortunately, the investments I made in Idaho and Utah, which is really, those are the ones that I've retained. The rest I kind of sold off and deployed that capital elsewhere. But they were new builds. They were the same builder, kind of a turnkey offering to investors. So there's one property management company that's managed all of them. So I have 16 to 18 units under management from the same company. So I have,
Gotcha.
versus like 16 property management companies. So So to have this, I guess, several, rental investments somewhere under the same property management, there's some economies there. And again, I've done a certain amount of homework on the areas. I felt like they were promising, right? I mean, you look at a pro forma and then you got to use your own judgment, but I'm certainly glad I get in on those markets. The rents have really spiked. So again, I'm going back to our earlier conversation. Initially, maybe the cash flows were a little tighter, but the rents have risen a lot in the last 5 years. My costs haven't really risen that much because I have fixed rate debt. And these are newer properties, not a lot of maintenance. So I'm cash flowing really nice now, better than I would have projected initially. So I guess going back to your question on how do you get comfortable out of state, I think the first time is always the hardest, right? What am I getting into? But then if you do it once or twice, it becomes a little bit more routine. But I think finding a property manager, if you're buying your own property, is obviously key. Interviewing several, making sure, and maybe making sure you have some understanding of the metro. So, if you've never been there and you buy something, you're not quite sure what you're going to be getting into, maybe, right? And people have different objectives. And then the other thing, again, one of the reasons I kind of pivoted to the more passive model, investing as an LP, is that that's completely out of your hands. Somebody else is going to kind of manage those professionally, and they understand the area. There's pros and cons, right? Your investment's not as liquid, and you're relying on them to manage it. But I've invested in countless cities, right? In countless apartment complexes as an LP. There's no way I could have done enough homework to feel comfortable, buying my own rentals in those areas, right? Because I wasn't boots on the ground, and I don't know what these people knew. So again, there's advantages to each model of, managing your own, buying your own, and then maybe placing your capital with operators who are on the ground and really understand these different markets, right?